Okay, I promise this is our last mini lecture about bonds, and it deals with bond retirements. Now, bond retirement means you're basically paying off a bond. Most bonds retire at maturity. In other words, you pay off your bond when the due date comes. And that entry is really easy. You would simply debit bonds payable and credit cash, just like you would debit any payable and then credit cash to pay off a liability. But sometimes companies retire their bonds early. Now, why would they want to do that? Well, perhaps because the interest rate, the stated rate on the bond, is higher than the going market rate, and they decide they want to avoid the interest payments. And if they have the cash available, they may just want to pay off the bond early. So there's three effects. The company pays cash, they eliminate the bond liability or the bond payable, and they report either a gain or loss on the retirement. Now, a gain arises if the cash paid to retire the bonds is less than the carrying value, less than it's worth on the books, and a loss is incurred if the company pays more than the carrying value at the time of retirement. Okay, now when a bond has a premium or discount, experiencing a loss or gain is much more common than when a bond is issued at its face value. But the only examples we're going to use in our chapter, just to keep things a little bit easier, is bonds retired that were issued at face value. So in our example, assume that 10 years ago General Mills issued $100,000 of bonds at face value. If the company retired the bonds now at a bond price of 102, General Mills would have to pay $102,000 to retire the bonds. In other words, $100,000 times 102%, or 1.02. So we would debit bonds payable. I'm just going to adjust the lighting here a little bit. There we go. We're going to debit bonds payable for the face value. We're going to credit cash for the 102 that it takes to retire them, and debit the loss on bonds payable by the 2,000. Now let's take a look at a problem. And this is problem E10-8. This problem says that on January 1st, Innovative Solutions issued $200,000 in bonds at face value, and that means that the issue price was 100, right? They received $200,000 in cash, and they're going to pay back $200,000 when they're due. The interest payment is on December 31st. I'm sorry, I jumped up there. The bonds have a stated interest rate of 6%. The bonds mature in 10 years and pay interest once a year on December 31st. Okay, so that when these bonds were issued, the company debited cash for $200,000 and credited bonds payable for $200,000. If they were issued at face value, then if the stated rate was 6%, that means the market rate was also 6%. They want us to prepare the required journal entries to record the bond issuance, the interest payment, and then the retirement of the bonds. So we said that on January 1st, since this bond was issued at face value, to calculate the cash, and this really isn't necessary because that we know that if they were issued at face value, the company is going to get the full $200,000. But if we use the same formula we've been applying, we take the face value and we multiply by the issue price, which we know would be 100% if they're issued at face value. So the company receives $200,000 and they have to pay back $200,000. Remember, we always credit bonds payable for the face amount. Okay, now it's December 31st, and we have to make the interest payment on December 31st. Okay. We know that we're going to be debiting interest expense, and we're going to be crediting cash. There is no premium or discount to amortize. So let's calculate our bond interest payment. Let's multiply the face value or principal, 200,000, times our stated interest rate, 6% times our time factor, and that would be 12 over 12. They pay interest annually, which means once a year. So if we multiply that out, our debit to interest expense and our credit to cash will be for $12,000. Now in our third entry, they want us to assume the bonds were retired immediately after the first interest payment at a quoted price of 101. So this would also happen on December 31st. Okay. To calculate how much we're going to have to pay in cash to retire those bonds, so this will be a calculation of the cash payment. Let's multiply our face value times the retirement quoted price of 101, which is really 101%, and that will be $202,000. So we're going to debit bonds payable for the face amount, which is $200,000. Let's skip a line and jump down to the credit to cash. That's $202,000. And that will give us a loss of $2,000 on bond retirement. Now, a company does not have to retire all their bonds at once, as in this example. They could go into the market and buy back their own bonds whenever they would like. Some bonds have a call provision, which means the company has the right to buy back their bonds from the bondholders at a certain set price. Our book doesn't talk about that very much, but that is another option as well. Okay, back to our notes. And I told you in an earlier lecture that we would be talking later on about various types of bonds. We won't be spending a lot of time on this book. We'd just like to touch on a few things. Types of bonds. We can group them into two categories. First of all, the organization that's issuing the bonds. So we have the Treasury Department that issues bonds, and we call those Treasury bonds or treasuries. Municipal organizations such as cities, states, towns, those are called munis. And then corporations, which we call corporate bonds. Then the other category groups bonds based on specific features that the bonds have. Some bonds are backed by collateral, which means if the issuing company does not pay out interest on a regular basis or pay back principal, that debt is secured by some type of asset that can be sold to pay back the bondholders their principal and or interest. So those are called secure bonds. If there is no collateral, they're called debenture bonds, and that's the type of bonds that we've been learning about. Then there's the type of provision that we just mentioned, the call provision. Some bonds in their contract or indenture have a provision that the bond issuer can call in and pay back the bonds. That's a call provision. If bonds are going to be paid back all at once, like the ones we've been talking about, we call those term bonds. And there are bonds that can be paid in installments called serial bonds. There are also bonds that can be converted into stock, and those are called convertible bonds. And then bonds that have no periodic interest payments, they just appreciate in value, those are called strips or zero coupon bonds. One more topic before we close for the chapter, and that is contingent liabilities. Now the word contingent means depending upon, right? So contingent liabilities are potential liabilities that arise as the result of a past transaction or event, but their ultimate resolution depends on or is contingent upon a future event. To me, that sounds very complicated, but let me give you an example and hopefully it'll be a little more simple. Let's say you own a business and it's a winter month, let's say it's the month of December, and someone's shopping at your place of business and they fall outside and they're hurt and they're taken to the hospital and they sue you because they feel that their injury resulted because you did not properly salt your sidewalks or shovel the snow. Well, will you have a liability to pay them once if the lawsuit is lost? Well, let's say that the fall was the past event. And will you have an actual liability? Well, it's contingent upon or depending on a future event, the lawsuit, what will happen. What do you do with this information? How do you report it? Well, it depends on the likelihood that that will occur. So, if it's remote, you talk to your attorney and the attorney said, you've salted, you've shoveled, it's a remote chance that you're going to lose this lawsuit. Don't even bother mentioning it. If it's possible that you may lose the lawsuit, then you need to describe it in the notes to your financial statements to let your stockholders know that you're a party to a lawsuit that possibly could be lost. If it's likely, if it's probable that you'll lose the lawsuit, and the amount can be estimated, that is, the amount of loss can be estimated, then you would record an actual liability, an entry like this one. If it's probable that you'll lose the lawsuit, but there is no way to estimate the amount that you would lose, then you would make sure to mention it in the financial statements. And finally, in Learning Outcome 10-5, we're going to spend just a few minutes on this because we'll visit it again in Chapter 13, a couple of ratios. First of all, the debt to assets ratio, and it's exactly what it sounds like, total liabilities divided by total assets, and it indicates the percent of assets that are financed by your creditors, and a higher ratio means greater risk. There's also the times interest earned ratio. Does the company have enough resources from operations to cover interest expense? Well, the way we do this is we take net income and we add back both interest and income tax expense, and then we divide by interest expense. And the higher the number, the better the coverage. In other words, the more able the company is to pay its interest. And we're all done with Chapter 10. You can go to your Connect work and work on your homework. Take care.